A dramatic sell-off in chip stocks has sent shockwaves through the tech market, raising questions about the sustainability of this year's AI-driven rally. Are investors facing an imminent correction? Here's everything you need to know about today's turmoil. Looking ahead, the earnings reports from Alphabet and Intel, set to be released next week, will be pivotal for market dynamics. These reports are particularly critical as they come at a time when investors are already wary of the tech sector's volatility. Alphabet, with its vast array of digital services, and Intel, a cornerstone of semiconductor manufacturing, are both seen as bellwethers for the health of the broader technology industry. If these tech giants fail to meet high profit expectations, it could deepen the ongoing sell-off in chip stocks, which have already been under pressure due to rising production costs and supply chain challenges. Such a downturn could potentially spread to other technology sectors, leading to widespread investor anxiety. In this environment, many investors may seek refuge in defensive sectors, such as utilities and consumer staples, or pivot towards non-AI tech companies that may offer more stable growth prospects. This shift could lead to broader index weakness, compounding the volatility already present in the market. Compounding these concerns is the uncertainty surrounding Federal Reserve policy. Recent statements from Chairman Kevin Warsh suggest a cautious approach to inflation, yet lack a definitive strategy. This ambiguity adds another layer of complexity for investors trying to navigate market conditions. As geopolitical tensions and inflationary risks loom, the market faces a critical test of resilience. The question remains, are we on the brink of a short-term correction, or can the market rebound in the face of these challenges? Analysts are closely monitoring these upcoming earnings reports, as they could serve as a crucial indicator of market direction. Investors must prepare for potential volatility and adjust their strategies accordingly in the coming weeks, making informed decisions based on the unfolding financial landscape. The path to this sell-off began over the past year with massive capital inflows into AI-related stocks, particularly chipmakers like Nvidia. These investments created a concentrated rally heavily reliant on continued AI spending, as companies raced to capitalize on advancements in artificial intelligence technologies. The excitement surrounding AI led to inflated valuations, with many investors believing that these stocks would continue to soar indefinitely. Recent data showing softer inflation, including consumer price index and producer price index figures below expectations, initially fueled optimism in the market, suggesting a potential easing of monetary policy from the Federal Reserve. However, growing concerns about the sustainability of AI spending have triggered a reversal in sentiment. Analysts have begun to question whether the current pace of investment in AI can be maintained, particularly in light of potential economic slowdowns. Furthermore, geopolitical tensions between the U.S. and Iran escalated earlier this week, causing oil prices to rise and weighing heavily on market sentiment. Rising energy costs can lead to increased inflationary pressures, which would further complicate the economic landscape. This combination of factors has made investors increasingly cautious about maintaining high-risk tech positions, leading to the current sell-off in the chip sector. The impact of this sell-off is significant, as it not only affects tech stocks, but also has broader implications for investor confidence and market stability. A decline in chipmaker stocks could hinder technological advancements and innovation across various industries. Looking ahead, investors will closely monitor both economic indicators and geopolitical developments, as these factors will play a crucial role in shaping market dynamics. If inflation remains subdued and geopolitical tensions ease, there may be a path for recovery in the tech sector. However, if uncertainties persist, further volatility may lie ahead, challenging the resilience of AI-driven investments. The recent decline in chip stocks has raised significant alarm bells across the financial landscape, as it threatens to undermine the broader market rally that has been predominantly driven by AI-related investments. In mid-July, the AI trade stood as the primary engine of the stock market's upward momentum, propelling major indices to new heights. However, the recent sell-off in semiconductor stocks indicates a potential sector rotation away from these tech winners, compelling investors to reassess whether the profit growth in the AI sector can truly justify current high valuations. This situation is compounded by ongoing geopolitical tensions, particularly the war in Iran, which adds another layer of complexity to the market environment. Investors are increasingly wary, as any earnings misses or guidance cuts within the AI sector can trigger sharp sell-offs, given the heightened sensitivity of the market to negative news. The semiconductor industry is particularly critical because it serves as the backbone for AI technologies, with many companies reliant on advanced chips to power their innovations. The decline in chip stocks not only reflects investor sentiment, but also highlights the fragility of supply chains that have been disrupted by geopolitical conflicts and pandemic-related challenges. For the average investor, the implications of a sustained decline in chip stocks could be profound. A continued downturn could lead to broader weakness in major benchmarks like the S&P 500 and Nasdaq, which would directly impact retirement accounts, mutual funds, and individual investments. The technology sector has been a significant driver of wealth for many investors over the past decade, and a shift away from this growth narrative could alter investment strategies and risk appetites. Looking ahead, analysts suggest that the market may face increased volatility as investors navigate these challenges. If chip stocks do not stabilize, we could see a broader pullback in tech stocks, prompting a reevaluation of investment portfolios. Additionally, if geopolitical tensions escalate, it could further suppress investor confidence. Therefore, it is crucial for investors to stay informed and agile, as the potential for sector shifts could reshape the investment landscape. The coming weeks will be pivotal, with earnings reports from key players in the semiconductor space likely providing critical insights into the future trajectory of both the industry and the overall market. A cautious approach may be warranted as uncertainties loom. On July 18, 2026, chip stocks experienced a sharp decline, marking their steepest weekly drop in over a year. Around 10 a.m. Eastern Time, U.S. stock index futures fell significantly, reflecting growing investor anxiety. This sell-off intensified following Netflix's dismal earnings forecast, which sent shockwaves through the tech sector. The decline in chip stocks was further exacerbated by news from a prominent Chinese AI company, which announced significant technological advancements, raising concerns about the sustainability of the current AI spending spree. This development has sparked fears that the rapid pace of investment in artificial intelligence may not be viable long-term, leading to heightened scrutiny of tech stock valuations. As investors paused ahead of upcoming earnings reports from major players like Alphabet and Intel, uncertainty loomed over whether these companies could meet high profit expectations. Geopolitical tensions, particularly the ongoing conflict in Iran, have added another layer of complexity to the situation. The current climate is markedly different from past tech sell-offs, where external market pressures primarily influenced stock prices. Today's decline is rooted in deeper fears regarding an unsustainable AI market, coupled with a potential rotation away from high-flying tech stocks into more stable investments. The impact of this decline is significant, as it not only affects investors, but also the broader tech ecosystem. Many companies within the semiconductor sector rely heavily on continued investment and growth in artificial intelligence to drive their revenues. A downturn could lead to delayed projects, layoffs, and reduced innovation. Analysts are now closely watching how these tech giants will navigate the turbulent market. Should Alphabet and Intel fail to meet expectations, it could further erode investor confidence, leading to a more pronounced sell-off across the sector. Looking ahead, the tech industry faces a critical juncture. Companies must address both the immediate pressures of earnings expectations and the long-term sustainability of their growth strategies in the face of evolving geopolitical landscapes. With upcoming earnings reports on the horizon, the next few weeks will be pivotal in determining if the current downward trend can be reversed, or if a more prolonged period of caution will settle over the tech sector. What do you think will happen next for the tech market? Will the chip sell-off continue, or will we see a recovery? Share your thoughts in the comments, and don't forget to subscribe for more daily deep dives.